Hi guys, I'm BP. In this video, we are going to see the chapter 17 in the book The Intelligent Investor. The chapter 17 is 4 extremely instructive case histories. It's nothing but we are going to see these following 4 companies' histories. The companies are Penn Central, Ling-Temco-Vought, NVF Corporation, and AAA Enterprises. Okay, let's get started. Graham uses this example to illustrate the dangers of investing in companies that have bad financial problem, poor management, and over leveraged. Okay, Graham also uses these companies' case histories to illustrate the importance of thorough research and analysis before investing in any company. One should definitely not rely 100% on the other's opinion while investing. Rather, he should always do thorough analysis and research while before investing in a company. Okay. Now let us see the history of Penn Central. The Penn Central company is the largest rail network company in America in 1960s. The company is formed by merging the two big companies like Pennsylvania Railroad and the New York Central Railroad. At first, this merger was considered as a high profitable and high growth company, but at the end it became a failure. Now let us see what goes wrong in the company. At 1960 itself, the Pennsylvania Railroad Company has a high debt and a high operating cost to run the company. After merging in 1970s, the new Penn Central Company operational cost further increased and they borrowed more debt to finance their operation cost. At the later 1970s, the company couldn't manage their debt and because of the poor management, the company announced the bankruptcy in 1970s. Graham says it is one of the major bankruptcies in the later 1970s. The key takeaway is the poor management and the high leverage can make a company to file a bankruptcy. Okay. The second one is Ling-Temco-Vought Industries. This is a story of head over heels expansion and head over heels debt, ending up in a terrible loss and a host of financial problems. At mid 1960s, a young boy who take over the company as the chairperson. He is so ambitious and he is rapidly acquiring many companies but out of his main core business. This over a period of time led to more debt and serious financial trouble so that at the end the company could not handle their debt so that the company filed the bankruptcy. Graham says whenever the company is acquiring the company but it is not related to its core main business, then an investor should be so careful while investing in that company. Okay. The third and fourth are NVF Corporation and AAA Enterprises. For that, I am going to give you an Indian company example which filed a bankruptcies. The two companies are Jet Airways and the Reliance Communications. Okay. Now let us see what went wrong in the Jet Airways. It was one of the second largest air industry in India, but in 2019, unfortunately, it went bankrupt. Okay, now let us see what went wrong. The company had a serious issues of high debt and a poor management, but the real problem started in early 2010. The company had a strategy of aggressive expansion so that in 2010 the company planned to increase more flights and more routes across the country. But unfortunately, after 2010, the fuel cost increases and an economic slowdown also happens. This led to affect the profit of airlines. Over the period of 2019, the debt increased so high so that the company cannot even pay the interest for that debt. So that at 2019, the company filed a bankruptcy. The main key takeaway is not even the company's debt or the poor management, even some economic slowdown also led companies to bankrupt. So that the investors should always careful of economical situations which is related for that company and an industry. Okay. Fourth company is Reliance Communications. Not because the company filed a bankruptcy, because of the and poor management and high debt, but also the company had a borrowings in dollars and the company had a earnings in rupees. So that while dollar appreciates and rupee depreciates, the company tend to pay more interest than they paid before. It is because the company borrowed while the dollar was trading at 70 rupees, but while repaying the debt, the dollar now trading at 80 rupees. The profit remains same, but while currency conversion, the company led to pay more interest and debt. It even leads to file a bankruptcy at the end. The key takeaway is by which currency the company is borrowing money and by which currency the company is making earnings and repaying the interest and debt. Okay. To conclude this chapter, Graham says the four important things. First one, the company should have less debt and the company's policymakers and the board of directors should not aggressive in expansion and acquisitions that is not related to their core industry. The third one, Graham previously suggests that We should also consider the economic factors while investing in stocks. The fourth one, the thumb rule Graham says is, if the company has a debt, should have asset double times its. If the company has a debt of 50 crores, then at least the company assets should value more than 100 crores so that the investor can consider buying the company. Okay, in the next chapter, we are going to see the comparison of 8 pairs of companies. Stay tuned. Thank you.